Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Hainan Drinda New Energy Technology Co. Limited quarterly report. Hainan Drinda New Energy Technology Co. Limited offers a range of services related to photovoltaic cells. The company's primary focus is on the design, research, development, production, and marketing of these solar cells. Specifically, it specializes in generating N-type TOPCon solar cells. The company's expertise spans multiple areas within the new energy technology sector. Its core business involves creating high-quality photovoltaic cells for both domestic and international markets. With its headquarters based in Haikou, China, Hainan Drinda New Energy Technology Co., Limited, has established itself as a key player in the field of renewable energy solutions. The company's services can be broadly categorized into several areas. Design. The company engages in designing photovoltaic cells that are efficient and effective. Research and development. It invests heavily in research to improve its products and stay ahead in the market. Production. Hainan Drinda New Energy Technology Co., Limited, produces high-quality solar cells for various applications. Marketing. The company markets its products globally, catering to both domestic and international clients. Overall, Hainan Drinda New Energy Technology Co., Limited, services are centered around creating innovative solutions in the field of photovoltaic cells, contributing significantly to the growth of renewable energy. Hainan Drinda New Energy Technology Co., Limited, market capitalization of 23 billion is significantly larger than the average industry peer of roughly 1 billion. This shows that Hainan Drinda New Energy Technology Co., Limited, holds a significant advantage in their industry. Hainan Drinda New Energy Technology Co., Limited, trades at a higher price-to-book ratio of 2.07 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation, signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 78% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline can be identified through an analysis of various factors. On one hand, revenue growth is primarily driven by a significant increase in unit selling price of solar cells, with a notable 113.38% and 110.87% rise. Additionally, the optimization of supply and demand relationship in the photovoltaic industry has contributed to revenue growth. Furthermore, the release of demands in key overseas markets and an increase in sales price of PV cells due to improved industry supply and demand have also played a crucial role. On the other hand, the primary driver of revenue decline is attributed to a decrease in operating revenue by -9.63% year-on-year. This decline suggests that the company's revenue has been impacted negatively, likely due to various market or operational factors. The net income of the company underwent a substantial change between two periods. Initially, it was reported as a loss of RMB 105,889,418.57, but by the end of the period, it had transformed into a profit of RMB 13,481,677.84. This significant turnaround is reflected in an increase of RMB 119,371,096.41. The improvement in net income can be attributed to a notable enhancement in operating profit and non-operating income. As a result, the company's profit margins saw a considerable boost. The exact figures for this change are not provided, but it is clear that the company's financial performance has improved significantly due to these factors. The company's financial performance indicates a consistent trend of generating positive operating cash flow. According to recent data, both the current and previous periods have shown an increase in operating cash flow, with figures standing at 984,673,146.54 and yen 1,320,104,933.53 respectively. This suggests that the company is effectively managing its operations and generating sufficient funds from its core business activities. The company's debt level has undergone significant changes in the recent period. A notable increase was observed in short-term borrowings, which rose by a substantial 83% from $1,057,646,717.17 to $1,932,056,973.37. This surge is more pronounced compared to long-term borrowings, which increased by only 7.8%. The total liabilities also saw an increase of 4.5%, indicating a moderate rise in overall debt. However, despite the increase in debt levels, interest expenses have actually decreased from $72,472,541.21 to $69,374,310.30. This reduction suggests that the company may be benefiting from lower interest rates or more favorable loan terms. This development is worth noting, as it contrasts with the overall trend of increasing debt levels. The financial performance of various segments and regions has been analyzed based on the extracted summaries. On a positive note, the cash received from disposal of investments showed significant improvement, with a current period total of $561,460,158.06 compared to $2,100 million in the previous period. However, several areas have underperformed. Net cash flows from operating activities declined substantially, with a current period total of -$703,637,770.79 compared to -$308,443,721.40 in the previous period. Additionally, the cash paid for acquisition and construction of fixed assets, intangible assets, and other long-term assets decreased by $41,572,392.45 from the previous period. Furthermore, net cash flows from investing activities also showed a decline, with a current period total of -$436,815,464.13 compared to -$1,251,996,289.49 in the previous period. These underperforming areas indicate that there are opportunities for improvement and optimization in these segments or regions. The management of the company is expressing optimism about its outlook, citing robust demand momentum in the global photovoltaic market. This growth is driven by two key factors: the increasing power of artificial intelligence computing and the transition to clean energy. The company's performance has been impressive, with a significant year-on-year growth rate of 113.38%. This strong foundation sets the stage for future development, indicating that the company is well-positioned for continued success. The company's financial activities have been focused on share buybacks in recent periods. According to the provided information, the company has invested a significant amount of cash in buying back shares. In the current period, the company paid out $710 million for this purpose, which is a substantial decrease from the previous period, where it spent $3.29 billion on share buybacks. This indicates that the company's priorities have shifted towards returning value to its shareholders through share repurchases rather than other forms of investment or dividend payments. That concludes the financial summary for Hainan Drinda New Energy Technology Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.